Good morning, everyone, and welcome to our session this morning.
Good morning.
Professor, how are you?
Fine. How are you?
I'm feeling okay.
I'm okay, thanks. How are you?
I'm good, I'm good. Garcia, everything okay?
No, everything is fine. Thank you. Good morning.
Okay, good morning. Your screen is dark. We can't even see you. Anyway, we can hear you. Okay, there we go. Madam Emma, don't say anything about
Yes,
the video there, please. Emma is happy for you. Yeah, she's happy to see you.
who?
Madam Emma,
Who?
Garcia, working from home.
I can't see him.
Oh, you can't see him.
No.
Okay. Mr. Mfuni, can you also see Mr. Garcia?
No, I can't.
Yes. So this man has strict.
No, I can't.
Who is able to see him?
I can see him.
You can see him.
Now he's visible. Now we can see him.
You see what working from home can do? Huh?
Yeah.
He's working from home.
COVID.
COVID. Okay. Not one of the most handsome men around, but it's okay to work from home. Okay, so today we are going to go right away into pricing, and what we do, we are going to go into questions. So after questions, I'm going to give you an assignment on the theories. So to just get our game underway, I want to mention that there's something that the examiner likes when he brings the pricing topic in the exam. Pricing is important because we all buy things on a daily basis and we sell things. So companies buy and sell, companies set prices, companies make new products, companies manufacture new items. So it's important that we understand pricing before that fateful Tuesday morning. So to get our game, I have a series of questions that I've compiled, and we're going to do those questions together today. And I'll give you an assignment on pricing. So just to mention, there are things that one must just know about pricing. We're going to talk about those things after we do the question, but let me take you to, okay, workspace. There we go. Okay. Madam Emma, find for me an assistant. I need an assistant.
Okay.
I'll pay them very well.
I think Professor can be one.
It can be a bad assistant.
What is a job description?
Yes, you see what I'm talking about? He's already asking me questions. We're talking about number one, when discussing pricing, number one, we want to talk about a few things. Number one, we want to understand factors influencing pricing. So when the examiner brings questions, he asks about factors influencing pricing, other than the price itself. You see? So you have to understand the factors influencing. So the factors that influence pricing, other than the price itself. You must know the factors that influence pricing. And of course, we're talking about, there has been things such as monopoly, oligopoly, etc., those kind of stuff. We can look at those ones. It's rare that I've seen the examiner brings a question on oligopoly or monopoly. It's very rare. But you can also talk about the PED. You have to know what this means. Price elasticity of demand and the price elasticity of supply. So you have to know these two guys if you are to survive. But most importantly, what you must know is this guy here. I'm going to put this one in a different color. Know the different pricing strategies. The different pricing strategies are very important because here the examiner has a lot of questions for you. So you must know the different pricing strategies, and you must also know this Kalito thing here, life cycle pricing. It's also related to what we're going to be doing today. So know the life cycle pricing, very important. Yeah, but most importantly, know the different strategies of pricing and when each strategy is suitable. That is when that's what the examiner wants you to understand. So we're going to do a bit more of the theories as we near the end of this session. But to start with, let's go to an exam question and just do an exam question. So there we go. Okay, so we can go to an exam. Okay. We have looked at the exam questions and pricing that we are going to look at this morning. Can you see the question? Can you see the question?
Yes, we can.
Okay, good. This question right there. This question. So this question from the past exam paper. And then there's this other one. And okay, there's this one. The question I want us to look at, it's not that one. I want us to look at this. Yeah. Okay, this one. There we go. So you see, look at the questions. We've been told to advise Becky Fashions. Advise Becky Fashions on the choice of the two appropriate pricing strategies for the new and unique classic outfit. What you state about here, for you to advise on the pricing strategy, you must know the pricing strategies that are there. I think I mentioned earlier, we're going to talk more about that one. What strategy can you advise? And then you've been told to explain the difference between elastic and inelastic demand, give examples to illustrate your answer. Okay. What else do we have? There we have another question there, which are going to do calculations on. So let's begin. Madam Emma, what is the easiest question on those lists? We always start with the easiest question in the paper. So from what we've been asked, what's the easiest? Madam Emma?
Yes, I'm just going through. I think we'll start with B.
Okay, what does this say?
Advise Baker Fashions on the choice of two appropriate pricing strategy for the new and unique classic outfit.
Okay, so now for us to advise, we must read the story. So now read the story. So you may read the story for us, then we can give an advice. Okay, read the story. Read the story.
Just a minute, just a minute. Let me just know. Following the splendid performance and crowing of the mighty Zambia nation team in the just ended Confederation of Africa Football, CAF champion, hosted by Equatorial Guinea, and Gabon. Beck Fashions has designed a new and unique classic outfit for the soccer fans across Zambia. The proprietor of Becker Fashions is inexperienced in the business world and has come to you for advice.
Yes. Have you seen? So they've come to you for advice. So you see, when we discussed the strategies, you see, a pricing strategy is a strategy that helps you maximize profits at any given point in time. So you must know what strategy to use at each point of the life cycle of a product. That's why we said you must know the life cycle pricing. So here, we are being told to advise. Now, there's a keyword here. Professor, what's the keyword in this statement which will help us advise on the best pricing strategy?
New.
Yes, there's a word new. Okay, so you see, there's a word new, this word, new. Why is the word new a keyword? Professor, why have you picked new?
This is because it's the one which is going to help us identify the type of a product which they are putting on the market, and it will also help us to determine the pricing strategy which is going to be used.
Yes, so now you see, there are lots of pricing strategies available on earth. But you see, there's a strategy called skimming pricing, and then there's a strategy called penetration pricing. There are different kinds of strategies available. Full cost plus pricing. All those strategies can work when you're trying to put up a new product. But the most suitable one for a new product is skimming. Why do we choose skimming? We choose skimming because skimming is a pricing strategy where at the inception of the product, you are going to be forced to charge higher prices. And let me illustrate why we're choosing skimming. Let's use a diagram here, just to add more life to this one. So here we've been told these guys are making a new product. So let's say here is our diagram. We've got the introduction stage for the pricing for the product. So the product is being introduced here, and after some time it will begin to grow. So there will be growth. After that, there will be maturity. And after that, eventually, the product does a natural death like a BlackBerry. So now what happens here is this. If you've seen here, at introductory stage here, there are different kinds of strategies you can introduce. Number one, you can use skimming here. The reason why we're saying skimming may be suitable for introduction, because here, before you introduce the product, you had incurred costs. There could be planning costs, designing costs, there could be research costs, lots of costs. Sometimes you change the standard, sometimes material costs, lots of costs that were incurred prior to the introduction of this new product. Now, the best way to recover all these costs that you incurred at the initial stage, have you seen? It is best to use what? To use skimming, because the skimming is a strategy which helps you to charge high prices. So skimming, you're going to charge what? You're going to charge higher prices. You charge high prices at start. Why? Because you want to recover those costs. So it is not just about saying that it is skimming. The other reason why we're talking about skimming, because when the product is a new product, and at the same time, it is also unique. Have you seen? So the product is not just new, but unique. This means that at the moment, you don't have competition because your product is new and unique. So it is only best for you to charge higher prices so that you recover these initial costs. There could be hundreds of these costs, not just what you've written here. So that as the market grows, competition begins to come in, you can do what? You can reduce, you can change from pricing to other what? From skimming to other pricing strategies. So here you could have also talked about penetration. Even penetration is also good at introductory stage. How? This one may be suitable where there's already existing competition. You see? There's existing competition on the market. So what do you do for you to penetrate the market? You come and you charge lower prices. Why are you charging lower prices? Because you want to gain an equal market share. You want to gain an equal market share. You see? That is the skimming, that is penetration for you. This one, if you, for example, in Zambia, we have MTN, we have Airtel, we have Zamtel. See how hard it was for Vodacom to penetrate the market. It was hard. They had reduced their internet, they had reduced lots of things, but still up to now, they've not been able to penetrate. I hear that they're even going back to where they came from because it's been difficult to penetrate the market. So there are lots of barriers to entry, but what you want to do to penetrate is to charge lower prices so that other people can begin to come to us. People get to know you. Now you can do what you can change and now charge higher prices because now people know your products. So it is not just about knowing the pricing strategies, knowing when the strategy is most useful. Okay, anything else there? Yes, we've got something else. Another thing that you could have talked about, full cost plus pricing. So there's also what we call cost plus pricing. We would have talked about cost plus pricing. So you would have advised bakery fashions to use cost plus pricing. Now, you see, bakery fashions in this case, we will need to ascertain the cost for producing one outfit. So what this one means is that here you simply get the cost for producing one outfit. What is the cost of producing one outfit? And then what do? You add up a markup on top. It is very, very much easy, this one. It's not complicated. So here, just get costs plus markup. So you could have advised in much deeper details. As we go, we are going to talk about more. We're going to talk about what happens at growth, what happens at maturity, what happens at decline. But for the purpose of this session, we are restricted to the introductory stage, what we could have advised that company to use as a pricing strategy. So we're going to talk more on growth, maturity, and decline. So for now, let's go back and do another part of the question. Okay, Madam Emma, we okay? There was the word new here and unique. So skimming just makes sense. And that was 6 marks, meaning that each strategy you advised was getting 2 marks, 2 marks, 2 marks. Number 2, Madam Emma, what's the question? We are being told to explain the difference between elastic and inelastic demand, giving examples to illustrate your answer. Professor, can you give us the difference between elastic and inelastic demand and give examples? That is 5 marks.
Elastic.
Yes.
Elastic demand. This is the demand which do not change or which changes as the levels of activities changes.
Okay.
Well, in elastic, it's the demand which do not change despite the changes in the levels of activities.
Well, when it says the demand should not change, you are misleading because it changes, on that it changes by a very small percentage. I will say it's different from elastic. When the price is elastic, let's say a change of 10% in the pricing might result in a change of 15% in demand. Have you seen? Yes, so what you said is true, but what is more true is that you should have given your answer a proper format, because it's 5 marks. An exam will not give you 5 marks for saying elastic of demand is the price that change with the level of with the price that change according to whatever you said. The exam will not give you 5 marks for that. The exam will give you 5 marks for first defining what this is. Have you seen? Define that plus the elasticity of the difference between elastic and inelastic demand. What is elastic demand? Explain it. What is inelastic demand? Explain. Then give examples also. Have you seen? They told you to give examples, so you didn't give examples. You see, an example of elastic product is a holiday. You see, you could have talked about things like that. You could also have talked about inelastic demand. Have you seen? And also could have given an example of an elastic demand. And an example of inelastic demand could be an essential food, meal meal. No matter how much we increase the price of meal meal, people still buy because they need to eat. So give examples, define, give an example. If possible, if there's a formula, even show the formula. However, what you've said is true, only that you could have done it much more better. So there we go. We have another question here. Now this question is a calculation. Now this is where we're going to enjoy learning pricing. So we are beginning to do this. So selling pricing, see the question says calculate what the selling pricing should be in order to maximize profits. Maximize profit. Then if the selling price was set to maximize revenue, calculate the resulting profit. So here, let's explain a few things here. When you're in the exam, doing a pricing question, and then you see the word maximize profit. And then there's the word maximize, not profit, but revenue. So you have to be careful, because if you don't see that there's a difference between profit and revenue, you might end up doing the same thing twice. So profit is maximized at this point. So you have to know this. Number one, know that the price that maximizes profit is achieved at the point where marginal cost is equal to marginal revenue. Marginal cost is simply incremental cost for producing one extra product. The same is true for marginal revenue, simply incremental revenue for selling one extra product or unit. You see? So, because marginal cost is incremental cost, in the exam questions, the examiner will never give you a figure and call it marginal cost. What the examiner will do is going to give you a figure and call it variable cost. So, variable cost is the cost that increases according to the level of activity, or as the level of activity changes, variable cost also change. So therefore, on the place of incremental cost in the exam, we replace with what? With the variable cost. Incremental revenue has got a formula. Incremental revenue, marginal revenue has got a formula. Marginal revenue is equal to A minus B, A minus 2B Q. Or some questions put X, A minus 2B X. The 2B means this here. On the pricing equation, there's this function. We say price is equal to A minus B. P represents price, current price. This one represents our current price, our CP. And then A represents price at which demand is 0. Have you seen? It's price where demand is what? Is 0. That is A. B represents change in price over change in quantity. Percentage change in price over percentage change in quantity is what is represented by B. So This is the pricing equation. P is equal to A minus BQ. Some questions put BX. So let's go. Let's say your P, you're looking for the current price, and the A is 20, and then the B is 0.01, and then the Q, let's say the Q we still don't know. If you sell one extra product, this B here, which has been classified as 0.01, is going to change to 0.02 because now you've sold an extra unit. Have you seen? So this, when it becomes 0.02, the 2 simply shows that at first you only sold one, but now you've sold an extra unit. So it has given you extra revenue. That is where this formula comes from. Marginal revenue as a formula, which is simply A minus 2BQ. To show that now you see it was BQ, so meaning the coefficient was just 1. Now after selling another unit, it becomes 2B. Okay, that you must not forget. Now here the exam also tells you that if the selling price was set to maximize revenue. Now maximum revenue is achieved at this point. Maximum revenue is achieved at the point where marginal revenue is equal to 0. That's the point where you achieve maximum revenue. So these are a few things I need you to know before you move on. So how do you put this? You're going to bring the marginal revenue equation, put it there, and equate it to 0, like this. So marginal revenue is equal to A minus 2BQ will be equal to 0. At this point, you're going to achieve maximum revenue. These are the few things you must know because they don't change. When the examiner says maximum revenue, it's not talking about maximum profit. It's talking about revenue, ndalama, money, urupia, mali, mashedeni. So there we go. So now, can we do the work? Let's now do the work. So this question was beautiful because it has those few things brought out. So just remember, when you say marginal revenue, maximum revenue, etc., what we're talking about is what and what. Okay, so what happens here? What I need to tell you now is that when you use the marginal revenue equation, what you must now do is now go back to the original pricing revenue, original price equation. Have you seen? After using that marginal revenue is equal to A minus 2BQ, the figure you're going to find here, we're now going to take it to the real pricing equation here, A minus BQ. And now insert to get the price, because what you're simply looking for here is the quantity. We are going to insert there. Okay, so now let's do the work. Let's do the work. So there we go. Okay. So we've been told that Becky Fashions here does what they do. So C number 1, what you need to identify, you can get the selling price, what should be in order to maximize profit. The formula we know, we maximize profit at this point. Number 1, marginal cost should be equal to marginal revenue. And the examiner has told us the selling price equation has been given to us, selling price, that is the equation. Marginal revenue equation has been given to us, that is the equation there. Okay, so now what do? There we are going to get profit are maximized when marginal cost is equal to marginal revenue. Put that comment in the exam. Profit is maximized at a point where marginal cost is equal to marginal revenue. And then you say, here, what is the selling price here? So what is marginal revenue? We are going to say marginal cost. What is marginal cost? We are going to bring marginal cost. The marginal cost is simply the variable cost, which has been given to us in the question of 20. So 20 here will be equal to what is marginal revenue? Marginal revenue is this equation here. We've been given this equation here, which is 50 minus kwacha 0.002x. The x just means cube. So what do? This one comes this side, this 20 goes the other side. So it is now 0.002x will be equal to 50, this time minus 20. So now we have 0.002x, which will be equal to 30, over 0.002 over 0.002. So our x here will be equal to how much? Remember, the x or the q represents quantity required. So what is our x there? Our x will be equal to 15,000 units. That is the quantity required in order for us to maximize revenue. So now what do? We are now going to get this 15,000 units and take it to the normal pricing equation, A minus BQ. We are going to insert it on that one. So P is equal to that one, and then we insert on that one to get now the price. See? So there we go. So now what do we do here again? We now move on. What is our next step? What do we do? Remember, that is just the first question there. So when x is equal to 15,000, the selling price is equal to that one. So you can now get the selling price equation there and now insert those figures. So the equation was given to us. We are told that selling price equation is equal to 50 minus 0.001, and then there's x. So we found x. So selling price now will be equal to 50 minus 0.001 multiplied by what is the quantity? 15,000. So selling price now will be equal to 15,000 multiplied by 0.001. It gives us how much? It gives us 15. So selling price that will maximize profit should be 85 kwacha per unit. Nishimwasanga selling price which will maximize profit. Okay, that's how you find the selling price to maximize profit. Are we okay there? Professor, are we okay?
Only 2 marks.
Yes.
Only 2 marks because it is
Only
easy.
2 marks.
Yeah, it is easy. It is a well-deserved 2 marks because it is easy. So next, what do? We go to maximum revenue. Now I gave you an equation. I told you maximum revenue is maximized at the point, is achieved at the point where marginal revenue is equal to 0. So what do? We get our marginal revenue equation. What's our marginal revenue equation? Well, our marginal revenue equation is this. This one here. We've been given there already our marginal revenue equation. So we're simply going to say the 50 minus 0.002 x will be equal to 0. You see? So we're going to equate that. So what figures are we going to get when we do that? We are going to say here that 50 will now be equal to 0.002x over 0.002 over 0.002. So there we go. So x will be equal to how many units are those? That will be 25,000. Nishimwasanga, 25,000 units. X is 25,000. So now here, the examiner says if the selling price was set to maximize revenue, calculate the resulting what? The resulting profit. So what will be the profit? So now you have the unit now is 25,000 units. What will be the profit? So how do you do that? So here you say, you see, profit as an equation, profit is equal to, you see, contribution minus fixed costs. You get profit. Isn't that what we do? We say selling price minus variable cost is equal to contribution minus fixed cost is equal to profit. So now that's what you're going to do here. So how do we get our contribution? Our contribution is simply selling price minus our variable costs. See? So our selling price, we found already that our selling price is 25. Our selling price is 35 there. not selling price of 25. So now what do we do with the 25 that we found? So simply insert it there. We're going to say 25 minus 20, which is 5. 5 minus multiplied by 25,000. So we're going to say 25 minus 20 there. We have our figure there, and then we multiply by 25,000 to get our total contribution. And then what do? We remove our fixed costs of how much? How much were our fixed costs? 100,000. So how much is our profit?
The selling price is what?
How
35,
much is our profit?
25.
25. So that is our profit. So just remember there, when X is 25,000, selling price is equal to 50. Then you can use that equation for 50 minus 0.001 multiplied by 25,000 units, which will give you 25. Professor.
Huh? The selling price we found the 35. So 35 minus 20, that is 15. And 15 by 25. So me, I'm finding profit as 275,000.
275,000. Anyway, you could go that far, but this is how far the examiner wanted us to go. We weren't supposed to end at only 25,000. That is where we're supposed to end. So we have about less than 30 seconds before we start another session. Let's rejoin on the other side. So those of you who are still watching, we are now going to do this question here. Question number 21, it's an exam question for pricing. Join us in the next less than 2 minutes.